Hello everyone, welcome back to our class. Today's lesson is about the financial institutions prepared by Mr. Rasheed. Class SS1 and 2. Definition and types. Financial institutions are the main channel by which funds flow from one sector of the economy with surplus funds to other sectors with insufficient funds to ensure efficient utilization of such resources in the promotion of economic growth and development. Financial institutions may be broadly divided into two groups: banking and non-banking financial institutions. The banking institutions include commercial and merchant banks, development banks, and the central bank. On the other hand, the non-banking institutions include insurance companies, equipment, leasing companies, hire purchase companies, building societies, discount houses, etc. Commercial and merchant banking. The commercial and merchant banks are profit-making enterprises as well as the major financial intermediaries through which the monetary authorities facilitate effective distribution of money in the economy. Functions of commercial banks. 1. Accepting deposits of money. Commercial banks as savings institutions provide facilities for the mobilization of savings by accepting deposits from households, firms, and government. They use current account, saving account, and fixed deposit account to accept demand deposits, saving deposits, and time deposits, respectively. 2. Granting of loans. The most profitable function of commercial banks is extending credits to worthy borrowers while interest is collected on the money lent to borrowers. 3. Acting as agents of payment. Commercial banks keep money on behalf of their customers and equally assist in settlement of debt and for payments for goods and services. 4. Providing international trade service. Commercial banks are involved in the financial aspects of international trade, especially by discounting bills of exchange for the customers who are exporters and opening letters of credit in favor of their customers who are importers. Functions of commercial banks continues here. 5. Foreign exchange services. Commercial banks act as intermediaries between the central bank or authorized foreign exchange dealers and their corporate customers to process foreign exchange allocation. Number 6. Safekeeping of valuable items. Commercial banks undertake to keep for their customers valuable items such as government stock, share certificates, academic certificates, certificate of occupancy, jewelries, insurance policies, and etc. Functions of merchant banks. 1. Acting as issuing houses in the capital market. Merchant banks are engaged in issuing or floating of new securities for private and public companies and for government, state, and local seeking to raise long-term or permanent finance for their projects. 2. Accepting deposit. Merchant banks accept large deposits from their customers, mostly corporate bodies. Such deposits attract interests and can be withdrawn only with certificate of deposits and not with checks as in the commercial banks transactions. 3. Providing foreign exchange services. Merchant banks are authorized dealers in the foreign exchange market. As a result, they are engaged in the buying and selling of the foreign exchange for commercial and other purposes. 4. Project financing. The merchant banks are engaged in the financing of new industrial and agricultural projects on the understanding that the repayment would be made from the revenue stream generated by the project. 5. Providing these advisory services. Merchant banks have offered advice to their clients on project financing, joint ventures, mergers and acquisitions, debt financing, and on the rationalization of the company's capital structure. Number 6, equipment leasing. The business of equipment leasing, as described under commercial banking, is more popular with the merchant banks. Equipment leasing can be in the form of finance lease, where a bank provides funds to a firm to purchase the equipment, or operation lease, where a bank or lessor buys the equipment and rent it out to the firm. That is the leasee. Other financial institutions. Finance companies. Finance companies are institutions that specialize in short-term non-bank financial intermediation. Their activities include mobilizing funds from the investing public in the form of borrowing and providing facilities for local purchase order, project financing, equipment leasing, hire purchase and debt factory. 2. Helping companies to establish efficient management structures and controls. And 3. Providing corporate finance advice such as on capital restructuring and project financing services. Discount houses. Discount houses are financial institutions which intermediate funds between the central bank, licensed bank, and other financial institutions. Their activities include 1. Mobilizing funds for investment in short-term securities, especially treasury securities and other short-term financial instruments by providing discounting, rediscounting facilities. Number 2. Assisting financial institutions to effectively manage their idle cash balances by bringing together a surplus and deficit units in the money market. And 3. Underwriting issues of treasury securities, thereby promoting monetary policy objectives. Insurance companies. Insurance companies consisting of life and non-life institutions are also important financial intermediaries in any economy. Their main functions are 1. Mobilizing relatively long-term funds in the form of premiums from policy holders, thereby promoting savings in the economy. 2. Investing their funds in bonds, stocks, mortgages, and government securities, in the process contributing to effective utilization of scarce investable resources. 3. Providing palliatives in the form of claims where a policyholder suffers a loss. Hence, they encourage asset acquisition and facilitate the growth of commerce and industry. Central bank. A central bank is the apex institution of the monetary and banking system of every country. It is owned by the government but the responsibility of its management is usually vested in the board of directors, whose members are appointed by the government. The Central Bank of Nigeria, CBN, and Bank of Ghana, BOG, and they are among the earliest central banks established in the West African sub-region. Traditional functions of the central bank. Currency issue and distribution. The central bank is the only institution empowered by law to issue currency notes and coins that are used as a medium of of exchange in the country. The banker's bank. The central bank provides facilities for other banks, especially commercial banks, to keep their cash reserve and clear the balance through the clearing house. Banker to the government. The central bank keeps the accounts of the government and of all its corporations and agencies. It receives all payments due to the government, as well as undertake borrowing on behalf of the government through the issuance of short-term and long-term securities, for example, treasury bills, treasury certificates, and long-term securities, for example, development stocks. Promotion of monetary stabilities. The central bank controls money supply in the economy to promote price stability. This involves the use of instruments of monetary policy such as open market operations, OMO, reserve requirements, discount rate, etc. Foreign exchange management. To ensure that foreign exchange disbursement and allocation are consistent with economic priorities, the central bank acquires, allocates, and monitors the use of scarce foreign exchange resources, as well as maintains the country's foreign exchange reserves. And the last one, supervision of finance houses. In every modern economy, the central bank is backed by law to monitor and supervise the activities and practices of financial houses in order to promote effective execution of monetary policy. Thank you for listening. Stay safe. Bye-bye.